What's going on, investors? With the recent downturn in the market, several blue chip companies are at some very attractive bargains and offer some really high starting dividend yields. And one of these companies is the dividend king 3M, which has well over a 4% starting yield. This is a company that has paid increasing dividends for 64 straight years, but in today's video, we will review if 3M can make it to year 65 and beyond. Just make sure you've hit that like button for the algorithm to help out a small-time channel and are subscribed for more great content. I'm going to start off first with the pros, and there's really not a need to give much of a background on 3M. I'm going to assume that you know what this conglomerate industrial company does. They're heavily involved in making adhesives, office supplies, medical equipment, tools, among so many others. Some of their most popular brands are Post-it notes and Scotch. Yeah, not the whiskey, but the tape. Though 3M does make hand sanitizer, which comes with 61% alcohol. Some of their business segments include safety and industrial, which grew 8% year over year, and this was primarily due to 3M helping make masks for C-19, and the year prior, 3M was heavily involved in making respirators. Their transportation and electronics segment was up 9%, but they did have some declining sales in their auto OEM segment because of the ongoing shortage of semiconductors. Its estimated elective medical surgeries are only at 90% of pre-C-19 levels, so there's certainly a lot more room for growth with all of the healthcare products that 3M provides. This past year, 3M rewarded shareholders with $3.4 billion in dividends paid out and share repurchases of $2.2 billion. 3M in their history has awarded over 126,000 different patents, and over 90,000 different employees work for 3M worldwide. So this is a gigantic company, and it definitely leaves its footprint on the world in more ways than one. But more on that in a little bit. It's time to talk about why 3M's stock price is tanking. 3M reached its apex of almost $260 towards the end of January 2018, and it has never hovered near that price again in the 4 years since, losing almost 50% value. In recent times, this could be attributed to some global events. The industrial sector, after all, is down about 8% so far. But 3M is down nearly 20%, so we know it's a little bit more than the usual suspects. Worldwide supply chain issues, raw material shortage, and logistics challenges certainly aren't helping 3M. So macroeconomic factors, including inflation, are hurting 3M, but the biggest elephant in the room is 3M's lack of revenue growth these last couple of years. In 2011, 3M had $30 billion in revenue, and for the next 10 years, 3M's revenues remained almost exactly at those levels, ranging anywhere from $30 billion to $32 billion before topping off at $35 billion this past year. And how much of that might really be inflated by the company just happening to profit off of C-19? The guidance the company gave in its most recent earnings call was organic sales of 2 to 5% and total sales growth of 1 to 4%. That's not exactly the eye-popping numbers investors want to hear. And sure, this really stems down from that we are just spoiled with companies like Apple, Amazon, Microsoft, posting double-digit year-over-year growth gains and revenue numbers going to the moon. And I understand that 3M is a totally different industry. It's a much more older company, but 3M is stagnant. It's like that construction in progress sign that you've seen on your local main road for the past couple years. No progress ever seems to be made on the actual road though. What's also a major turnoff, in case we were dating 3M all of a sudden, is that their dividend growth has been abysmal. Just a 5.7% dividend growth rate in the last 5 years. And the last couple of years of dividend increases for 3M have went like this. They went from an 8-cent raise to a 3-cent raise to a penny raise to another penny raise this past spring. To me, this shows that management just is not optimistic that 3M can post stellar returns and continue to fund that increasing dividend. They're just giving penny raises at this point just to keep their dividend aristocrat streak alive. Very similar to what AT&T was doing, and we all know how that ended up. 3M's payout ratio is in the 50%, which isn't too bad, but even that might be hard to sustain because I haven't even talked about the worst news concerning 3M. The company is facing serious litigation for faulty products that they have been selling for years. A major blow was a $110 million verdict 3M was forced to pay for earplugs that they offered, which were later found to be defective and actually cause hearing loss. These earplugs were promised by 3M to block out sound, and many members of the armed forces used them and are now experiencing hearing loss. There are still around 300,000 pending lawsuits on earplugs alone. That is a lot of money that 3M will have to throw at this, and that's money that could be spent on improving the business and paying us dividends. Unfortunately, that's not the only lawsuit related to 3M, as there's also an allegation that 3M's production of chemicals contaminated drinking water in the Twin Cities area, known as PFAS contamination. 3M is forced to pay settlement payments as well as money for investigations and cleanups. These amounts were nearly $900 million in 2018 and around $500 million in both 2019 and 2021. Analysts think that these total liabilities could cumulatively reach around $20 billion for the PFAS lawsuits, and for earplugs, Morgan Stanley believes best case scenario is $2 billion in losses, and $53 billion is the worst case scenario. So that's a huge headache right there. Johnson & Johnson infamously made a separate legal entity to shift its telecom powder liabilities, and that separate entity would file for bankruptcy. So who knows if 3M might do something similar. 3M, like all other companies, probably has some level of insurance for lawsuits. So the stock market is always going to be looking into the future, not the past. So this is already priced into 3M's stock price, and it's one of the many reasons why the stock is slumping. Now the $1 million question, am I buying 3M at these prices? Now that's a really tough question for me to answer because I already own 13 shares of 3M and it makes up about 1.7% of my portfolio, and they pay me about $75 every year just for owning them. In fact, their most recent dividend payment of $18 auto-dripped into buying more shares of 3M. However, I remember what Warren Buffett said about buying great businesses. I want to buy businesses that have constant innovation, that have growing revenue streams, that have a good balance sheet. They deliver high products and services. I want the company to increase their dividends a good amount every year. And based off everything I just went over, I no longer believe 3M is that company, especially when we have so many alternative choices in companies that we can invest in the stock market that don't carry the same litigation risk. Honestly, ask yourself this question. If this company didn't offer such a high starting dividend yield, and it didn't have that amazing track record of 60 plus years of increased dividends and 100 plus years of uninterrupted dividends, would you still invest in this company? Clearly, the company has serious quality control issues, and that's a problem when you sell thousands of products. Just remember that a company is under no obligation to pay you dividends, and just because they paid increasing dividends for the past 64 straight years, that doesn't necessarily mean that they will continue to do so for the next 64 years. I'm thinking worst case scenario, all these lawsuits will turn ugly and 3M is forced to slash that dividend. Analysts don't seem to show much love to 3M either, with just one strong buy rating, 15 holds, 5 sells, and 1 strong sell rating. Though their 12-month price target is much higher than today's prices. But I know I could be too pessimistic, and I'd love to hear what you have to say about 3M in the comments below. Do you agree or disagree with some of the statements I've made? I might still drip into 3M, but until I get better color on their litigation progress and revenue guidance, I'm just happy holding my shares and buying into better companies. If I was someone who had never owned shares at 3M, my decision might be a little bit different, and I might be comfortable taking that extra risk of investing in 3M and getting that high starting dividend yield. Now, this video took a lot of time to research and produce. Please just hit that like button. It's a great way to help out a small-time YouTuber, and it encourages me to make more content. Just make sure you subscribe for more dividend videos, and as always, my videos are found in podcast form under the Collect Cash podcast name, and I will buy, stash, and collect cash you later.